Picture this. You are a founder. You have been pitching for 7 months. You have had 43 meetings. You have answered the same questions for your CAC to LTV ratio so many times you answer it in your sleep. And then finally, a term sheet lands in your inbox. $2 million. Pre-money valuation of $8 million. Standard safe with a discount. Your co-founder cries. You call your mom. You book a table at their restaurant you've been saving for when it happens. And then 3 weeks later, the investor calls, and within 90 seconds, you know that it is dead. No funding, no second chance. The term sheet gone. So what happened? That's the entire episode. Welcome to Inside the Deal Process. I'm Gurmeet Kaur, and with me, Navun Singh, and today we are pulling apart a deal that almost happened. We are going to show how and what investors actually look for in due diligence and what founders almost always get wrong, and what this specific founder could have done to save the deal. If you are raising or planning to raise, this episode is mandatory. Let's get into it.
Alright, let's set the scene. The company is called Meridian B2B SaaS. They build workflow automation software for mid-market logistic companies. Think replacing spreadsheets and WhatsApp threads with actual structured process. So, a real problem, logistic operations are notoriously messy. You have got dispatchers, warehouse managers, third-party carriers, everyone on different systems or woes. No system exactly. And Meridian had found a sweet spot. They weren't going after the enterprise players. Too long, a sales circle, too much competitions. They were targeting companies doing between 50 and 200 millions in revenue. Companies that feel the pain but can't afford 500k USD dollars. Implementations, smart positions. What did the numbers look like? On paper, genuinely impressive. 18 months in, they had 11 paying customers, ARR of $340,000, month over month growth averaging around 12%, and their NRR, net revenue retention, was 118%. Yes, 118% NRR in 18 months is a real signal. That means existing customers were expanding. They weren't just keeping customers, they were selling more to them, which is exactly why the investors, a seed stage fund called Torrent Ventures, got excited. Torrent was a $16 million fund, typically writing 500k USD dollars to 2 million checks into B2B SaaS. They backed 3 companies that had made it to Series A in the last 2 years. They knew the pattern. Now, why the investors said yes? The initial thesis. Okay, so let's get inside Torrent's head for a second, because this matters. What did they actually see that made them say yes to a term sheet? 3 things. First, the problem was real and the ICP was specific. They weren't building workflow automation in abstract. They had picked a vertical logistics and a size band, mid-market, and they had receipts, paying customers in that exact band. Second, the founder, Raina, the CEO, had spent 8 years in logistic operations before starting Meridian. So she had the experience. She wasn't a tech person who discovered a market. She was an operator who built the tool she wished she had. Investors love that. There's a phrase in VC, founders market fit. It's almost a click at this point, but it's real. When a founder has lived the problem, they have an unfair advantage understanding customers' pain. That's basic experience. In selling, in product decisions, Torrent saw that. And third, the NRR, 118% in a vertical SaaS business at this stage. That tells you the product is actually working. Customers are growing with it. That a retention story and an expansion story at the same time, so that say send the term sheet 2 million at an 8 million pre-money. That's 10 million post-money valuation. Torrent takes roughly 20% of that company. Now you understand, right? Deal structure breakdown. Let's break the structure down. Quickly, for people who aren't deep into weeds of this, because deal structure matters. The terms tell you what the investors actually believes. So, $2 million investments, 8 million pre-money, that implies 10 million post. Torrent gets 20% ownership. It's structured as a price seed round, not a safe, which is already telling you something. Torrent wanted the protection of a period round. They included a 1x non-participation liquidation preference, meaning if the company sells, Torrent gets their 2 million back before the founders see a dollar. But they don't double dip. Standard, not aggressive at all. Pro-rata rights on the next round, meaning they could invest again at Series A to maintain their ownership percentage. Also, standard for a seed fund that believes in the company. And a family standard 4-year vesting schedule for the founders with a 1-year cliff, nothing predatory in the terms. This was a fair seed round form an investor who actually wanted it to work. That's important context for what happened next.
Okay, let's talk about due diligence, because I think most founders have a very surface level understanding of what happens after a term sheet. Most founders think due diligence is like a background check. The investor is just confirming what you told them is true, right? And it's that, but it's also much more than that. Due diligence is where the investor shifts from being excited to being analytical. They are no longer asking, is this exciting? They are asking, what could kill this? That's the fundamental shift in mindset. During the pitch, the investor is leaning forward. During due diligence, they are leaning back. There are typically 3 areas seed investor will dig into seriously. One is financials and metrics. Do the number actually say what the founder said they say? Number 2 is legal and captable. Are there any hidden landmines? And the third one is reference checks. What do customer and ex-employers and co-founder actually say? And here's what most founders don't realize. Due diligence isn't just about finding problems. It's about finding problems the founder doesn't know exist, or problems the founder knows exist and hasn't disclosed. And the second category is one that kills the deals. So Torrent starts their due diligence on Meridian, and here's where it gets interesting. Within 10 days, they find 3 things, 3 cracks. And the number 1 crack is the metrics weren't wrong, but they weren't what they have seemed. Remember that 118% NRR Rania presented? Yeah, that was the number they got everyone excited. When Torrent dug into that underlying data, they found that 2 customers accounted for almost 70% of the expansion revenue. The rest of the book was barely expanding. So the NRR headline was real, but it was masking a concentration problem. So you've got 11 customers and 2 of them are basically carrying the metric exactly. And when you lose one of those 2 customers, which in a small customer base is a real possibility, your NRR collapses. The story changes completely. That's not fraud. That's not even misrepresentation technically, but it's a number presented without the context that changes its meaning. And the crack number 2 is one of the co-founder Rania had, technical co-founder Dave, who built most of the product during reference checks. Torrent spoke to someone who had worked with Dave at the previous startup, and this person unprompted mentioned that Dave had been removed from that company's board after a dispute over IP. Torrent dug further. They found that there was an unresolved question about whether some of the Dave's early code he wrote before starting Meridian had been written while he was employed by a previous employer. Meaning, that employer might have a claim on that IP. That's essential if a third party has a legitimate IP claim on your core product. You don't have a product, and Rania knew there was a gray area here. She hadn't hidden it exactly, but she hadn't disclosed it either. She would have told herself it was probably fine, which brings us to crack number 3. Crack number 3, and that's one of the most human one. During the financial review, Torrent asked for the customer contracts, and they noticed something. 3 of the 11 customers were on month-to-month agreements with no annual commitment, which is itself is fine, but the way Rania had presented ARR, annual recurring revenue, she would included those 3 as if they were annual contracts. So was ARR number inflated? Not by a huge amount, but by enough that the actual committed ARR was closer to $280,000, not $340,000. And at the stage, the gap matters. It changes the story about the pace of growth. So to recap, 3 cracks: concentrated NRR, the IP cushion the founder had hoped would go away, and either included non-committed revenue. None of them is matters individually, but together they told a story about a founder who had been optimizing for the best possible version of the truth, and that's the what killed the deal.
Let's spend some time here because I think this is the part that most founders never get access to. What is the investors actually thinking when they decide to pull a term sheet? Because it is not obvious. A lot of founders assume it is about the problem they found, like the IP thing killed us, but that's almost never the whole story, right? The decision logic is more complex. An investor who pulls a term sheet is usually not saying this is single issue is fatal. They are saying the pattern this founder's behavior in how they handle information. I don't trust it. That's the distinction. The IP issue might be solvable. The ARR definition might be a rounding error. But when you stack 3 instances of the founder knew something and presented it in the most favorable light, that tells you something about how they will behave under pressure over the next 7 years. Because that's the real question a seed investor is asking. This isn't a 6-month project. I'm going to be on the phone with this founder when the product breaks, when a key engineer quits, when a customer churns unexpectedly. Do I trust how this person communicates? And Raina, who by all accounts was actually a great founder with a real product, had failed that test. Not because she was dishonest, but because she hadn't been proactively transparent. The risk investors actually take. Now let's talk about risk for a second, because I think founders sometimes forget that investing is a risk-taking business. Investors know they are going to be wrong sometimes. So what are they actually risk assessing? There are 5 categories of risk seed investor typically evaluates. Team risk. Can these people execute? Market risk. Is the market real and big enough? Product risk. Does the product actually solve the problem? Business model risk. Can this make money at scale? And information risk. Information risk, that's the one people don't talk about. Information risk is what don't I know that this founder knows? And now, will this founder communicate when the information is bad? An investor can underwrite market risk, they can underwrite product risk, but they cannot underwrite a founder who filters information. Because their whole job as a board member, as an advisor, is to help solve problems. And you can only help solve problems you know about. Exactly the best investors I have spoken to, and I have spoken to a lot of them for this show. They all say some version of the same thing. I can handle bad news, I cannot handle surprises. Give me the hard news early. Don't let me discover it. That's the whole game. And Raina hadn't played it. So, what would you have kept this deal alive? So, what's the counterfactual? If Raina had done something differently, what keeps this deal? 3 specific things. 1. Proactive disclosure on the IP questions before Torrent found it. I want to also flag something. Here's a question about some early code Dave wrote while employed at the previous company. We had legal look at it. We believe that the risk is low, but I wanted you to know here's what we have done to mitigate it. That conversation is uncomfortable, but it's 10 times easier to have it before the due diligence than during. Because during due diligence, the investor has already found it. They are not learning new information, they are just evaluating you. 2. Reframe the metrics honestly in the deck. Instead of 118% NRR, lead with 118 NRR driven primarily by 2 anchor. Customers with the remaining 9 on the flat or the modest growth. Here's how we plan to expand the long tail. That is better story, not a worse one. It shows self-awareness. And number 3, correct the ARR definition, because crystal clear in the deck, communicate ARR into 280,000 from 200 annual contracts plus 60,000K into monthly contracts. Total annualized return 340K. Investors respect founders who are precise about their numbers. It is signal they are not managing. they are running the business. All three of this, the IP disclosure, the NRR context, the ARR precisions, they make the company look more sophisticated, not weaker. And here's the thing, Torrent would have funded the version of the company, the now disclosed point. They wanted to fund Meridian. They pulled the deal because they lost confidence in the founder's judgment about what to share, not because of the underlying problems.
Okay, I want to step back here and talk about a bigger pattern, because Rania is not unusual. What she did is what most founders do, and what most founders don't understand why it's a problem, right? Most founders think fundraising is a sales process, and it's partially. You are selling equity in your company, but the analogy breaks down in a really important way. In a normal sales process, you are trying to convince a customer to try your product. If they buy and it doesn't work out, they can cancel, low stakes. But an investor is making a multi-year commitment. They are betting that this founder, this specific person, will navigate every type of adversity that comes with building a company, and the way they assess it, that is by watching how the founder handles information during the fundraising process itself. Fundraising is the interview, and the test isn't how good is your pitch deck. The test is how do you communicate when things are complicated. And founders who have been trained by accelerators, by pitch coaches, or like the mentors, by well-meaning advisor to optimize every number, to put the best foot forward, to never show weaknesses, those founders fail the test without knowing they are taking it. There is a version of investor relation that is basically sales, and there is a version that is partnership. The investor worth having are looking for partnership, and the partnerships require honesty about the messy stuff. The real arc of the deal is, let me give you the mental model. I think every founder should have going into a fundraise. The arc of deal has 3 phases, and each phase has a different job. Okay, phase 1 is conviction building. This is everything up to the term sheet. Your job is help the investor understand the opportunity, the problem, the market, the traction, the team. You are selling a vision, and yes, you are putting your best foot forward. Phase 2 is trust building. This is due diligence, and here your job changes completely. You are no longer selling a vision, you are demonstrating that you are kind of person who can be trusted with capital. The job is transparency, full stop. Phase 3 is partnership building. Once the money is in the account, you have stated a relationship that needs to last through hard times. The precedents you set in phase 2, how honest you were, how you handle complications, that's the foundation of every conversation you will have with the investor for the next decade. So if you optimize phase 1 at the expense of phase 2, if you get the term sheet by overselling and then watch the investor find the real story during due diligence, you have not only lost the deal, you have damaged your reputation with that investor, with everyone they talk to, and potentially with the next investor who gets a reference call. The venture world is very, very small. A term sheet pulled for integrity reasons follows a founder. Let's talk about what actually gets funded, because we have spent a lot of time on what went wrong. Let's talk about what right looks like. So, same market, same stage, a different founder, let's call her Priya. She is building in a similar vertical. Her numbers are actually a little weaker than Rania's, lower ARR, lower NRR, and earlier stage, and she got funded. She got funded with 2.5 million at 9 million pre. And here's why. During due diligence, the investor found an issue, a customer who had churn in month 4. That wasn't mentioned anywhere in the deck. Before the investor could even bring it up, Priya sent an email. She wrote, I want to make sure we discuss the churn from our 4th customer. We lost them in month 4. Here's what happened. Here's what I got wrong in the sales process, and here's what I have changed in our qualification criteria. Since with the full postmortem attached, she found the issue herself and brought it to the investor before they could bring it to her. And in that moment, the investor didn't see a problem. They saw a founder who runs towards hard conversation, who does postmortem, who learns fast. That's who you want to better. The deal got done in 11 days, fastest in that fund's history.
We are coming up on time. Let's give people the thing they actually use. One technical takeaway from today's episode. 1. Build your risk register before you start fundraising. Here's how. Take a bank document. At the top, write everything an investor will find in due diligence that I haven't proactively shared. And then fill it out. Customer concentration issue, IP questions, metrics that need context, legal history, a co-founder conflict that got resolved, revenue that month on month, and then for every item on that list, prepare 2 sentences. Proactive disclosure. Not to apologize for, not to defend, just to name the contextualize and show that you have thought about it. We have customer concentration. 2 customers represents 65% of expansion revenue. Here's how we are addressing that in quarter 2 and quarter 3. Then you have inculcated the conversation because investors don't expect perfection. They expect judgment. Show them you can identify your own risk. That's the whole test. And the best investors, the ones who add real value, they will actually help you solve the problems you disclose. That's the point of relationship. But only if they know that the problem segment. Let's close with the theme of this episode. How do investors decide? They are running 2 parallel evaluations. The first one is the business evaluation. Is this a real market? The product working? Do the numbers say what the founders say? They say, can this grow? And the second one, the founder evaluation. Is this person someone I can work with for 7 years? Will they tell me that the hard things when the hard things happen? Do they have the self-awareness to know what they don't know? Are they building a real company or are they managing my perception of the company? The term sheet is the end of the evaluation number 1. Due diligence is the evaluation number 2. And most founders don't know the second evaluation is happening. Raina passed evaluation 1, she failed evaluation 2. Not because she was bad founder. She wasn't. Not because the company was bad, it wasn't, but because she hadn't understood that the game changes after the term sheet.
We end every episode with a question for you to sit with. This week, here it is. If the investor you are pitching right now had unlimited access to everything in your business, your Stripe data, your customer contracts, your Slack messages, your cap table, your reference network, what would they find out that you haven't already told them? Write down your answer and then ask yourself, why haven't you told them yet? Whatever comes up, that's the conversation you need to have before you are in a term sheet, not after. That's the episode. If this landed for you, share it with the founder who is in the middle of fundraise right now. They need the more than most people realize. I'm Gurmeet Kaur with me, Nabun saying, see you next week.